infinite banking takes a lot of work. I mean, really, as for the agent or whoever the advisors are going to be, to understand this takes some effort, as well as it takes effort for the client. This isn't like you want to do a 401k, we'll just sign here, give us a blank check or whatever. I mean, all you got to do is sign here, give us our money. That we have an education approach. We put people through a strict education process before we even start underwriting or really dive deep. So it takes a lot of effort on both sides. And to be honest, a lot of advisors don't want to take that effort.
Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Welcome to the lab. I have these two fine gentlemen here, and I call them fine off the air, so it's only right that I call them fine while we're on the air. And I'm very interested to have these two gentlemen in the lab here with me today, because we're already talking about offline, geeking out about this topic. I've only had a few folks talk about this, and I think it's like the seven wonders of the world, for lack of a better word, that investors are not really keen on, even sophisticated investors. And so I think it's really important to have this discussion, and at least, when we come in the lab, it's about trying proofs of concepts, and folks have done it before. And these gentlemen, these two here, have done it themselves as well and have helped others do the same. And so, I want to welcome them. And then I'm so excited to talk about a topic that is top of mind. I was literally just talking about this with another investor that I work with who's been in the space for a while. Shout out to Z. We were just talking about this, right? This specific strategy and model that is usually not up the sleeve of some very savvy investors. So without further ado, I want to bring in Anthony and Cameron to the lab here with me. That's Anthony J. Faso and Cameron Christiansen in the lab. What's going on, fellas? How are we doing?
Doing great.
We're excited to be in the lab.
Man, thanks for having
That's
us.
lovely.
We're doing fine.
No, it's all good. It's all good. But you know what?
Yeah,
everybody
next
else
time
got
we'll
their
bring 'em.
notepads on, lab coats. They know the drill. And I bust out the lab coat when we're gonna have a serious conversation. So, but like I always like to say, you guys are, I'm having some good energy. I can tell usually right away when I connect with people in the ash. I'm like, okay, what's the story? Because I believe what we put out into the universe, we'll put out to the world, whether it's our business, whether it's our content. I think you were talking to me about our content, is a true reflection of the who behind the machine. And so I always like to say, if I'm sitting next to you guys on a plane, I say, hey, what do you guys do for a living? I'd love to hear from both Anthony and Cameron. What do you guys say you do? And then I'm very interested about how did it all come together, right? So when I introduce myself to you, what do you usually typically say? I'll start with Anthony. What do you say? I know you called yourself the coach, so I'm putting you on blast.
Well,
Coach, what you got?
Okay. I would tell people, Ruben, if we're going to be honest, I hate that question, right? If I'm on a plane and somebody asks me what I want to do, it really depends what kind of mood I'm in, right? If I need to be focused, don't want to talk, I tell them I sell life insurance, and then I never hear a peep from them.
So that's a defense mechanism.
But yeah. But if I'm feeling that kind of good energy, like you had talked about, what I tell people is we help people incorporate or execute the strategies that Rich Dad Poor Dad had in his book, and we combine that with the infinite banking concept, which allows them to increase their return while saving money in taxes. And then that may open up the conversation, because what it is. I mean, I know we're going to dive deeper into the infinite banking concept, right? And the product that's used is a specially designed whole life policy. When people hear that, a lot of there's immediate assessments, right, of what they think it is. Most of the time
Yeah.
it's in the negative, right? But and I get it, because I've been a CPA almost 30 years. And when I had my own firm, I had these guys coming in trying to wanting to sell whole life to my clients. I'm like, I'm looking at this I can't recommend it,
Mm.
right? There's no cash value, a ton of death benefit. It's not really helping my clients solve the problems that they have. But with infinite banking, it's designed so much different. And really what people want, they don't want life insurance. But what they do want is the benefits life
Mm.
insurance
Okay. Okay.
provides,
So no, so
right?
so this is
So,
interesting because like um yes, I agree. So it's interesting that you say life insurance to turn somebody off because I think I would agree. I think there is
yeah.
somewhat of a negative connotation around it. Um and I want to ask you why in a second. But let me actually share with you guys a little key takeaway I got from a conference that I was just at, or one of the masterminds I was at, and it said, one way to rephrase that question for those of you who might be like, why does he hate that question? Let me ask you, Anthony, why do you hate that question? Then I want to ask Cameron the same thing, but and maybe you don't hate that question so much. I love it because I love to tell people what I do, and there's a way to do that. But um, what? Why do you not like that question? I'm curious.
It's more of an internal thing. And it's like, I don't want to be perceived as a salesman. And I don't want to have to give like this little speech where I'm trying to, entice somebody to take some action. Like, to me, going up to some, like, we were just at a conference as well, and doing like the networking it's
Mhm.
not one of my skill sets, right? But like, I can come
Yeah.
up and teach and talk, like, as Cameron will tell you, sometimes you can't shut me up, right, if you get me going. But it needs to be in the right environment. I'm not this smooth slick guy who can just work a room or just likes, kind of that conversation. I have a
Mhm.
fear of failure, right? A fear of rejection. So when I talk to somebody like this, it's, might think I'm going to be rejected, right? And I don't like, in a casual conversation, maybe
Yeah.
somebody's just being nice, right? But in a business setting, when they really want to know, like, I can shine, or I'm more comfortable doing it. But just at an airplane, well, what do you do? It's like, I don't want to get in that deep conversation unless they really want to.
That's
But
interesting.
I,
That's interesting.
I
Hey,
don't know.
I'd love to, actually unwrap that a little bit. But I definitely want to get to Cameron because, um,
It's okay. No, we're good. Ruben, you and me are just, we got this
you're
vibe
hilarious,
going,
man.
right?
So, Cameron, how do you feel about the question? And what do you actually tell us? What do you do for a living? And how would you answer that?
Yeah, Ruben, how I feel about it is that when I
Mhm.
built kind of the business, right? Our business is we're out here in Las Vegas, and what we used to do is we used to run around this town, or at least I did when I first started. I'd run around this town introducing people to the
Mhm.
infinite banking strategy. And it is a difficult question, to be honest, right? Because everybody's taught, hey, you got 10 seconds, 30
Yeah.
seconds for an elevator pitch. But man, it's a strategy, right? So it is a
Sure.
sequence of steps that you got to teach somebody. So I think that's why it's very intimidating when someone says, "Hey, what do you do?" To come up with something that's really quick and flashy to get somebody to be like,
Yeah.
"Wow, that's amazing! I want to learn more." Right? But typically, the way that I answer everybody is that I tell them this: is I say, "Hey, uh, we're specific. We work with real estate investors, so our slogan is infinite banking for investors." If you reference this book, right? Everybody's read Rich Dad Poor Dad. Ruben, this book is really all about mindset. Is like, hey, what are we thinking? How are we going to create wealth? And then what do we go do with it? Really, Nelson Nash's Becoming Your Own Banker book is all about where you
Mhm.
keep your capital. And so our philosophy marries those two ideas together, and that's really what we educate clients on is there's a great advantage that very few people know about in using life insurance and structuring that way, and specifically it's the loan provisions. And so that's what we're here to educate clients on and your listeners on is that there is a great advantage that very few people are
I love
aware of.
that.
So
Hey
I hope that
guys,
helps.
I can't help myself. This is the lab, so it's a
Yep.
safe space, man. I think you guys are on such a cool topic that I go deep into the personal development, public speaking, all that stuff, and I think you guys
Mhm.
need to tap in to an episode. And the gentleman, you talk about leaving an impression. I will never forget this man's name, Phil M. Jones, author of Exactly What to Say. It took me 9 follow-ups to get to this guy. It was during the pandemic. He's a big guy in the influencer space. Exactly What to Say, influence and impact in speaking. And you almost did it. And I would love for you guys to stick with that because they are so effective. And what he says is, it's fascinating. He says, everything's a story. And so the way he opens up, and the guy's British too, so it's so unfair because he's got that accent, dude. It's just like everything sounds so much better. It was like a riddle, the episode. But he's like, well, you know how individuals, well, you know how people read Rich Dad Poor Dad and it changes the outcome of their look on how they invest? Well, we take that same outlook and apply it to the way you're able to access capital by using a model called infinite banking. And then it opens up the question of like, well, what is infinite banking? Well, I'm glad that you asked. Well, infinite banking is that. And I feel like you guys are like in the perfect position to like leverage something that most people know and say, well, you know how. And if you listen to that, it's like a riddle. That's like one of the many things. It's one of my favorite episodes here, episode number 79. I would highly recommend you. And I'm glad you to listen to it. But I'm glad that this came full circle because I think it gives us, the listeners or whoever's watching this, the understanding of that it's a series of steps. I like how you said that, Cameron. And then Anthony calling out the elephant in the room, that if you've ever heard anything about insurance, some people just completely tune out. And the reason I want you guys to tune back in is because it's not the type of product that most people know about, right? Maybe I read another book. I forgot to mention it. There is this other book. I don't know if it's by Nash, but there's another gentleman, like he basically was talking about, this is what the Rockefellers were doing or something like that, like way back, like this. We're talking about old money,
Yep.
right? Like how it was preserved, how it was, protected, shielded, and at the same time, how you could earn while you're borrowing. So these, we hear private money lending, we hear, business line of credit, etc. My goal is to hopefully extract from these two gentlemen here as to, I always like to look at in the lab of, let's do a comparative market analysis or comparative product analysis. Why should I consider this versus something else? I think that gives people context, right? Or even, I'll give you guys another one too, right? Well, you know how people usually go to a private money lender for financing their deals? Well, with this approach, we actually allow you to become the bank. Like that to me is the hell of an elevator pitch, guys. And I would hopefully, yeah, this will be good. Maybe we can go back to this and you guys sound now, hey, listen, guys, I didn't charge for this, baby.
Yeah, Ruben, I tell you, to be honest, we thought we were going to come in here and kind of hopefully share some wisdom for you and your listeners, but it sounds like the opposite's happening. You're giving us the wisdom.
It comes full circle, yeah.
But no, and I think at the bottom line, Cameron and I are very passionate about infinite banking, and we view ourselves not as salesmen, but more as educators. So when we're in that salesman role, we feel a little bit uncomfortable, but you put us in an educator role or in that environment, that's where we feel most comfortable.
Yeah, no, words are powerful. And I think it's all about giving the other person a paradigm shift. Then I go in deep into this stuff. I love this kind of stuff, these conversations, like, how we say things and how we present ourselves. And that's why this is called the lab, right? I think people appreciate that. It's not, I'm not an expert. I just come along with the experts and we just open up the hood, see how it works, and kind of talk about it. So let's talk about this concept. Let's talk about it. So I think, Anthony starts to talk about it, right? In at a high level, but let me just ask you this question. Why don't more people know about this concept? Like, seriously, like this is a valid question, I think, right? Like we know how to get a checking account. Most of us do. Most of us do not know financial literacy. So that's a whole nother topic. But like we've heard of credit cards, we've heard of 0% interest. We've heard of, private money lending. We've heard of traditional financing. We've heard of, HELOCs, Loan. We've heard, I mean,
Mhm.
we've heard them, but why does this one slip through the cracks? What's your output on this? You're in the space. Why do we not talk about this?
I think there's a few reasons, and I will say I don't know if we don't know the exactly why, but this
Mhm.
this is my opinion. Okay, where we're infinite banking takes a lot of work. I mean, really, as for the agent or whoever the advisors are going to be, to understand this takes some effort, as well as it takes effort for the client. This isn't like you want to do a 401k, we'll just sign here, give us a blank check or whatever. I mean, all you got to do is sign here, give us our money. That we have an education approach. We put people through a strict education process before we even start underwriting or really dive deep. So it takes a lot of effort
Yeah.
on both sides. And to be honest, a lot of advisors don't want to take that effort. Having
Mhm.
assets under management, very simple, right? No education. You're getting your 1% per year as no matter no matter what happens. And the way here's what's interesting. One of the biggest complaints or maybe myths, I think would be a better way, myths about infinite banking, because when they're focused on the product, you know, the product that we're using, but really there's more to it. Infinite banking is more of a
Mm.
process on how you use that product. Now, and some of the common misconceptions of whole life is, oh, they just it's high commissions. That's why they're doing it. And but as I had said, the way we design it is very different. In fact, we're making a third a third of what somebody else doing more of a typical design. So another advisor can say, look, I could learn this system and this product and sell it, but I have to put extra time, and I'm going to make a third as if I just sell more of a
Wow.
typical whole life. So I think that there's some restraints, some barriers of entry for the agent as well as for the client. And then also there's some government regulation on how we can
Really?
market this. So yeah, we can't yeah, it can get way too boring for your show, but there is regulation on how we can market this. So you add all of that together, and it makes it harder for other people to really to
Well,
pick it up and market it.
mhm.
Ruben,
Yeah.
Ruben, I might add to that if you don't mind. Right? Is yeah, the question I heard you is why don't more people know about infinite banking? Right? Uh, if I look back at my experiences, most of the financial information that I got as I was growing up was from
Mm.
my family and friends. Right. And now we have clients that will call in and I'll ask them, where do you get most of your financial information? And it's usually family, friends, and then maybe like a podcast, right? Or a YouTube channel. There's social media channels that are starting to push content and information out there. And I think that's one of the big factors is that traditionally people have got information from family, friends. And I know it was my experience that my parents certainly did not know about infinite banking or how to structure an insurance policy by any means. And so if you look at where they could have gotten that information, the parents didn't know about it. The financial professionals, right, typically a CPA or their traditional financial advisor, is almost disincentivized to introduce this idea to them because most CPAs are just all about the tax deduction and what's available to them today. And so deferral is like the number one
Mhm.
tool in their toolbox. And so they defer that, they send it over to a traditional advisor, and then they talk to them all about all the tax deferred accounts. And so, Ruben, if you were to look at like uh, I stumbled there because I was going to say kind of the top IBC producers, which I would
Mhm.
absolutely put us in that category across the country, is that most of us are just business owners, right? And we were business owners and entrepreneurs that came across infinite banking. And once you learn infinite banking, Ruben, you almost feel an obligation to share it. And so if you look at some of the top producers in the country, none of us set out with this mindset of, hey, I want to be a financial advisor when I grow up, right? We're entrepreneurs. We found a strategy that fit, and then we just started telling everybody else about it, and they came to us asking more and more questions. And so uh, Anthony and I have been in this space for 15 years. To wrap up this question, we've been in this space for 15 years. Nobody had a clue about infinite banking when we started. Literally, like, we were the lone wolves, right? If you were doing it and you brought up this idea of infinite banking, no one had a clue. We were at an event last week, and there was 1,000, 1,200 people at that event. And I would say that half the people that we spoke to and said, "Are you familiar with infinite banking?" Half of them said yes. And to me, that was mind blowing because, man, for the longest time, we've been in this space and nobody's had a clue about it. And so I think it's a compliment to you, right? The people that are out there having this podcast, sharing these ideas that work with their listeners. So, man, I appreciate the effort
Thanks
that
for
you have out
answering
there.
that. And I always like to say too, right? It's depends what room you're in, right? When you put yourself in the right rooms, it's oh, you mean you're not doing that, right? It's a very different conversation, which is why
Yeah.
I honestly started this podcast, right? How can I there's obviously I like to always be very transparent because people always ask, I think sometimes you ask questions and people will be, well, I do it because I'm passionate. And let's be honest, like everyone has some ulterior motive. And I like the win-win ulterior motives. My win-win ulterior motive is if I can get educated and also be able to share with the platform. That's why I started my podcast. I didn't start it for downloads. I didn't start it for anything. I wanted to get into real estate. And so I started interviewing real estate investors before I even owned a piece of real estate. And so, and obviously, if you do a good enough job, you get to build a brand and a community around it, which I love. That's very interesting that you guys kind of were the only one. So let me ask you a question then. When which one between the two of you, how did you guys come across?
I was first.
I knew Anthony was
I
going
was
to come in
first,
strong.
Ruben. Okay.
So tell me,
Yeah.
what was, do you guys know, what's the relationship between you guys, by the way? Like, how did you guys connect? Because I always find that fascinating, like finding like-minded individuals and then being able to build something together. So what was your connection point? And then who found infinite banking first? I know, Anthony, you already claimed the answer to that. And where did you find
I'm going to let Cameron. We got two different stories. Cameron, mine is much more entertaining, but Cameron's probably more truthful. So let's go with the truthful.
So, Ruben, if you go back 15 years or so,
Mhm.
my wife and I are buying our house. And this is how I came across infinite banking. Is I was sitting down with our broker, and by the grace of God, I asked him if he had a good book for a young couple. And I was late 20s at the time. And he gives me this weird look and he goes, yeah. He reaches back and he grabs Nelson's book off his desk and he goes, if I'd have read this book when I was your age, it would have been the difference of millions of dollars. I walked out of that meeting, right? And I read Nelson Nash's Become Your Own Banker. I read it 3 times the first night and I got pissed off because on page 45 in that book proves to you that paying cash is not the best option. That is, in fact, one of the least efficient things you can do for investments or large purchases. And so that really upset me because I was operating on a cash basis. I had a successful business. I thought I was really smart, right? And here's something that's really basic that I wasn't aware of. And so that's what got me going down the infinite banking road. And long story short is I was looking for someone to teach it to me. Back then, I found one guy in the entire state of Nevada. It was not Anthony at this time that was teaching and had infinite banking as a focus of his practice. And I went down to him and I said, hey, man, is this legit? Number one. And then number two, is this something you can teach me to do for my business and also personally? And so we met with him and I started out as a client. And then at some point, I forget, it was maybe a year into it, he held an event where he was kind of bringing in professionals to introduce this idea to him. And so that's actually where Anthony and I met, was attending this event where we're being introduced to infinite banking. And it was literally, I think we got started the same day. That's why we argue about who's first. But him and I sat down at this conference table next to each other and we hit it off. And so, you know what? Him and I worked together at an old firm for probably almost close to 9-10 years. And then 4 years ago, we left and partnered on Infinite
Wow.
Wealth Consultants. And here we are now,
Yeah, that's
4 years
awesome.
later. Yeah.
I want to make sure this question doesn't slip
Yeah.
through the cracks, Cameron, right? You mentioned that you ask the question, is it legit? And I think typically I like the idea of telling people not what to think, but how to think, right? What are some of the kind of the analysis that you go through? Because there's a lot of information overload. I think Anthony talked about this. There's a lot of noise out there, right? So what do you what are some of
Oh,
the
great point.
metrics that you use when you're like when you ask that question, is this legit? What are you looking for? Are you looking for proof of concept? Or are you looking for show me the receipts, show me success? Like what is it that you're looking for to help a listener who might be listening to this and be like, well, how do I know Anthony and Cameron don't have another agenda? Like, how do I verify this, right? What
Yeah.
do you do and what do you suggest to somebody who might be listening? And what did you do at the time?
Man, great question, Ruben. What we refer to that as is we always refer to as fact versus opinion. Is to be honest, I'm pretty stubborn, right? Is I'll ask somebody for someone's advice, but I will listen and right as I take it with a grain of salt. And so when I came across infinite banking, I read Nelson's book, and in that book he goes through and he proves conclusively using illustrations and how this thing works that paying cash is not the best option. And so I started asking people about this, and I would be like, hey, do you know about this insurance thing? Can you borrow against it? And does it work? And every time you mention insurance, what I got is I got a whole bunch of opinions. Oh, insurance sucks, right? It's high commissions. It's terrible. Don't do that. This, right? And I would be like, great, that's an opinion, but share with me why, right? Like this on page 45 doesn't work. Nobody had any facts to back up their opinion. And so that's one of the things that I feel very fortunate enough that I didn't listen to the opinions is I would look at the illustrations and I would go through and I'd say, man, you know what? If I do this, then this happens and then this happens, right? And so that's the advice that I have for almost everybody that I talk to when they come and they're like, hey, is this legit or not? I say, hey, go through the process, go through the education process, read the contracts and figure out exactly how this thing works and make sure you have all the facts and tune out all the opinions because as you know, right, your own kind of experience is this idea is getting more and more popular and the facts are winning, right? The opinions are getting kicked to the wayside as people are starting to realize that this thing
Got it.
really does work.
That's a great answer, by the way. I love that. Facts versus opinion. So, I want to go back to Anthony, what you said, right? Because you talked about, and I love this, that it's so true. Um, People have kind of this instant gratification on both ends, right? Making money fast, right? If I'm, do you guys call yourself IBC? I heard you say IBC is that investment banking consultants.
Infinite banking for
Is that what
investors.
IBC stands for?
Oh, it stands for the
Concept.
infinite
Okay,
banking
got it.
concept.
So whether you're a consultant or I don't know if what you are an educator, um, you know, and you're licensed to be able to issue these, you told me it's 1/3. It's you're doing it more for because you feel like you're kind of have that calling to do it because you feel like everyone should know. And then on the other end, it's a process which we know that eliminates the barrier of entry, right? Or I should say the barrier of entry is high because people are not willing to do as much work. I get the blood work done, get the, you name it, right? So I find that very interesting and also like that because I personally, for the listeners, if it's easy for everybody to get into, then I think that kind of decreases the outcome, right? And if it's a higher barrier of entry on the value,
The
right, or
value.
the
Yeah.
output, right, and if it's a higher barrier of entry, then you're on the other end. There's a greater reward. Um, with that said, I mean, I think you stated it, Anthony, but what because this is this exists and we know this to be true, what are your thoughts on how this is going to grow? Is it going to be one of those things where you look at the economy and people are looking for an exit strategy? Like what is it going to take do you think, for people to then be willing to take those additional steps on both ends, whether you're the agent or the buyer? Again, this is completely subjective. I'm just curious to see what your thoughts are on that.
Well, that is a great question, and I think with advice, I think part of it is people are coming to the realization that the stock market, say rigged, or it's not for everybody. I mean, we view that you should invest in things that you know. And if you know stocks, then you should invest in stocks. If you don't know stocks, then you shouldn't invest in stocks or whatever that asset class is, whether it's real estate, short term, long term. It it doesn't matter. But I think what's going to happen is people are going to have to get upset with what is currently being offered. They're going to have to take the blinders off. I mean, 'cause right now we're kind of told max out your 401k, right? IRAs, 401ks are the only tool for retirement. But just like stuff like your podcast here is opening up people's eyes to other ways to generate income. So I think it's going to be, for some years, people will realize, hey, this 401k, I'm not in the lower tax bracket when I retire, or I need the money for an opportunity or for an emergency in my life, and all my money's tied up in my 401k. They have to pay taxes and the penalty to access. So I think for people to make a change, something negative is going to happen. So, and to be honest, that's what happened to me. I was more of your, I like to say I'm a recovering CPA. I mean, I was the guy telling people max out your 401ks and and follow a typical financial advice. But when 2008 happened, I saw what happened to me, but I also saw what happened to everybody else. And I noticed that this kind of happens about every 10 years. Like, there are these recessions. And then I realized, if I don't do anything different, why would I expect a different return? And I think more and more people are slowly, and then maybe it's coming even faster, that they're coming to that same realization.
So I'm going to find a way to tie this all together. Like I said, you guys relax, be the geniuses. I'm going to put a bow on this somehow. I love that you said that, because I feel like we're in the current kind of economy. There's a lot of shifts happening, right? Whether it's locally, across, internationally, etc. Right? So I may have made the assumption that, someone might be listening in like 20 minutes and it's like, what the heck are these guys even talking about right now? Right? So let's actually level set for a second before I go deep into this question, because I think that'll help tie things in. Okay. What is this concept that you speak of when you say infinite banking? What is the product? What is the benefit? And how does it work? We'll level set there, and then I'll kind of go into some of the questions.
Well, perfect. And now, if we look at what most investors are doing, like most in your show are doing, are in real estate, short term, midterm, or even long term. But typically, let's say you wanted to buy an asset, whatever it is, whether it's a house or you're using the arbitrage, and you need to pay for the furnishings. That's going to take capital, right? And we need to put it somewhere. So we typically put it somewhere that's safe and liquid. And we put it in this account. And then when we have enough to buy the asset, we drain the account and buy the asset, right? But then we want to buy another asset. So we do the same thing. We save up more money till we have enough. Then we drain the account and buy the asset. Now, that sounds great, but if we step back and take a look at it, the problem is every time we withdraw our money, we're breaking the compound interest curve.
Oh, you got to say that again for the people in the back.
Now, Ruben,
that's a good one.
Every time you withdraw your money out of your account to buy an asset, you're breaking the compound interest curve. Now, Ruben, at what point do you want your money to stop compounding? What would you say? Never. Good answer. Good answer. So all we're saying, this is why we're using infinite banking, is we have the ability to continue to do what you're doing. We want you to buy those assets, but we're just saying, if we finance them a little bit different, if we add one extra step, we're going to get that uninterrupted compound interest. And I'll put it into a story. Ruben, do you use rewards credit card? Well, why do you do that as opposed to just paying cash?
There's multiple, and I love where you're going with this, right? And this is my understanding. So call out any blind spots here, fellas. I think I got Cameron here who's going to be able to assess my answer while I'm speaking. So one, I want to get the points. And one, I want to use it as a leverage point, right? So at the same time, if I have a 0% interest rate, it means that I can have an opportunity cost where my money is can be working elsewhere while I've borrowed this money. So one, I would say leverage, one is points.
Yeah. So basically, the bottom line is, hey,
Mhm.
I add this one extra step. I'm going to buy it anyways, right? Instead of paying cash, I use a credit card, right? And then that allows me to get miles or some bonus or some extra fringe benefits. If you can understand that, Ruben, you can understand infinite banking. I kind of view infinite banking as like my rewards credit card for my investing. And what I do is I add that one extra step. Instead of a credit card, I use my policy. And again, this policy is designed differently, but I use that policy. And instead of getting miles, I'm going to get more money. I mean, so that's really it. I mean, we can get deep, and
Yeah.
honestly, I have a tendency to get really deep in the details, but this is really at a high level.
Sure.
This is what it is. And this is why I say, well, we're going to buy these assets anyways, right? We want to expand our portfolio. We want to create passive income to be more than our monthly expenses, which is one of our taglines, right? All we're doing is by adding one extra step, and what that's going to do is going to allow us to never break the compound interest curve, right? Ruben, imagine when you first started getting into investing, right? Imagine if that money was still compounding and growing, and then you could even use that growth
and I think
to buy more properties.
100%. And I
really,
think, Anthony, this is a great audience for that, because I think fundamentally, I think our investors, or some of those who are watching who own properties, understand the power of equity and appreciation and leverage. And I think we're just, missing the point of doing that initially, right? Because now you can have leverage on leverage, right? If you're leveraging your policy to then buy another asset, the fact that we're buying assets, you're already in the, what I would say, in the top percentile, right? Because you're not buying liabilities, you're investing. But now there's an additional layer there. And I want to go to Cameron for this, to help us build on what you just said, Anthony, because to someone who's listening, they heard the word policy, right? And they're like, okay, what, like, tell me more. Like, am I going in a dashboard? Am I, like, what is this? Like, what is this concept? What is it actually, a life insurance, or is it like, does it have, two different heads? Like, what is this product that we are talking about? Just so we're very clear, because I think we're clear, but in case someone's just super not clear what we're talking about,
Sure.
I'll help you both kind of bring this one home. Experiment Nation, you've heard the word MTR, mid-term rentals, as it is currently a hot topic and hot commodity right now, because again, there has been an increase in short-term rental regulations, and there also has been, let's face it, a slowdown in what we were experiencing a couple years back when it comes to bookings. So with that said, short-term rental operators are looking for alternative solutions to tap into the mid-term rental space. However, there is a sub niche of mid-term rental insurance that I'm truly excited about, that I want to share with you, that the experience that we've had, the tremendous results we've been able to have, and that's the insurance mid-term rental space, which is very different than your traditional mid-term rentals. When you think of traditionally mid-term rentals, you think of travel nurses. There is a space, mid-term rental insurance space, that we've tapped in, where you need to be well connected with insurance and relocation specialists and companies, and understand the right type of asset required for you to be able to help these families. What's really important, that stands out the most, which you can get in what I'm about to offer you, is the understanding where to be found by these insurance companies, how to properly manage your calendar so that your listings are optimized so that they can find you, how to actually gain traction and build a relationship with these relocation insurance companies. I've put together an MTR insurance blueprint, that's MTRR insurance blueprint, to cover these foundations after we've had success landing very large contracts on single family homes that literally 4x what we traditionally make in long-term rentals, and also gives us peace of mind because there's less turnover and 100% occupancy, because these contracts can start anywhere from 30 days to 3 months to 8 months and range anywhere from, again, we've landed anywhere from $8,000 to $9,000 a month in per month on a single family home property, which our mortgages are typically around the 2,400 range, which then gives you a large spread of anywhere from 4 to 6K net on just one property. And this is why it's very hot right now. But people who haven't been in the lab with individuals like myself, like Jesse Vasquez and Dr. Rachel Gainsborough and Noble Crawford, don't have the foundations and don't know exactly where to start. And therefore, this is why I'm giving you guys a blueprint, the MTRR insurance blueprint. Go to the website, experimentrealestate.com, and get yourself a blueprint to completely change, or at least have a plan B if you're a short-term rental operator looking to maximize your occupancy and profitability. We'll see you on the other side.
You're right. It's the product that we're going to be using is a whole life insurance policy. And we have a saying around here, but we say it's not your mama's policy, right? Is our parents, if you talk to baby boomer generation, silent generation, is one of the best places, or one of the main places that they stored their money was inside whole life insurance. And then in the 70s and the 80s, everybody got away from that. And so the problem, right, is that people got away from that product. But the solution now today is that we can take that product that's been around for 150 plus years and we can actually manipulate it a little bit. And what I mean by that is the traditional model means that you put money into a policy and you have this really big death benefit. But for infinite banking, it's actually the exact opposite. Is you're trying to minimize the death benefit and you're trying to maximize cash value. And so you're using the same product, but you're just using it the exact opposite that everybody has traditionally. And so the advantage of doing that, Ruben, is when you structure this for cash value, is there's loan provisions on your policy. And the loan provisions stipulate your access to those dollars. And what Anthony was talking about, that compound interest, is that if you borrow against an insurance policy, you don't take any money out, you're collateralizing it. And so that means that the cash value inside of your policy just continues to earn every single year. Very boring, just like Anthony's stories, just continues to churn out, right? While you're accessing the cash value with the loans, is then what you go do is you go do all this sexy stuff, right? The real estate investing, the medium-term rentals, short-term rentals, right? Cash flowing assets. And that's what's happening outside of the policy. But what you've got behind it is just that continual compound growth. So that's the process that you want to
hear
get
the word
into.
cash value, but I'm not clear how that works. What is that? How do I build that cash value? Is that based on like a premium that I'm paying? Is that monthly? Is that quarterly? Like, what is that?
Yeah.
When you say the word cash value, what does that mean for our listeners?
So if you have $1, in your checking account, right, that's $1 essentially cash. If you take that same dollar and you put it inside of an insurance policy, it shows up as $1 of cash value inside of your policy. And so cash value is really just capital money that's sitting inside of your insurance policy. And you've got two ways that you can access that. You can surrender, which just means you take the cash out, or you can utilize the loan provisions, which mean you're going to collateralize the cash value and you're going to borrow against it.
Thank you for that. Now, some of our listeners might be familiar with the concept of loan to value and LTV, and on the home side, right? You put down 20%, you have 80%, the bank is covering that, right? And I got to keep my 20% in there. I might be able to do a HELOC or a home equity line of credit or whatever. As the value goes up, I still have to keep that 20% in there. At a high level, obviously, we know there's a lot of education behind this, but while we're on the pod and we have both of you here, how does that value, work? Can I get 100% out? B, and they're not exclusive, so I should say part one is, can I get 100% out of what I put in? And I want to get to part two, is there some kind of, like, can I overfund it, or can I put as much as I want in there, right? If someone's listening to this, be like, oh, well, we got about $1 million. So, if this thing is right, let's put this $1 million to work. Like, how does that work? Let's start with part one of the 1-to-1 ratio. Is it a 1-to-1 ratio of what I can take out?
So the cash value that you have in the policy is a 1-to-1 ratio. So if you've got $100,000 of cash value, you can borrow $100,000 out as a loan, right? So 1-to-1 ratio there. In regards to how much could somebody put in there, it's really unlimited, right? So overfunding is the act of putting additional dollars in over and above that cost of insurance. And so we have clients that put in very large amounts of cash each year in the form of premiums into policies that just build that cash value up year over year. So yeah, you can fund it at any level you'd like, Ruben.
And we have some clients that are putting in a small amount. I
Yeah.
mean, what is one of the beauties of what we do is not like a typical financial planner where we need to have so much money in order to talk to us. I mean, we've kind of built this that we want to be able to help everybody, right? Everybody who wants to help. And we work with a lot of investors. A lot of times their income is kind of fluctuating, where they have a big windfall, not for a long period of time, because they want to go execute it. And what we do, the way we design it, we take the assets you have, or maybe better yet, the assets you want to put in the policy. Because going back to the beginning, like when we were first started, you know what? We, just like Cameron said, there was all these opinions, but very little facts we knew. So we each started with a small policy, just something that we felt, let's try this out. And I put it in and used it just like Nelson Nash said. So then I felt more comfortable, and I got another policy, and then I've got some on my family members, but I worked my way up to it. Right. And so wherever the clients are, we explain how and why this works. Then they decide what they want to put into it, whether it's on a monthly or an annual basis, or maybe they're sitting on some cash, or with a lot of our investors, it's a little bit of both. Right. When they need something that can hold a variable amount of funds depending on their situation.
And isn't there some kind of and excuse me if I forgot this, because you guys look at this every day, and I recall something along the lines of the product could possibly change if you put too much, if you overfund it or something like that. I forget if it's called like a PMC, or I forget what it is. A MEC. There you go. What's that? Because I think maybe some who might be listening, who might be familiar, why should I know that, and why is that important?
Sure. What a MEC stands for, Modified Endowment Contract. Well, really, I like to just say it really means the most efficient cash line, because what that means, anything above the MEC line is no longer taxed like life insurance. It's tax like an investment, or more like an annuity, where there could be taxes and a penalty before you're 59 and a half. Right. But what we can do with the MEC line, and this is where it's more of an art of when we design the policy, because we need to design the policy with that MEC line in order. And the MEC line is a complicated equation, but I could summarize it that it's a ratio between cash value and death benefit. So when we design the policy, we need to take the MEC line into account. So we make sure we take the funds that you want to put in, and we actually design the policy right up against a MEC line. So that's where so it's the most efficient cash policy allowed, and is still that we can maintain the tax freedom.
And again, I think just listening to this, right? It does sound like a lot of new information, and it is, right, to those who are listening. But again, that's where the opportunity is, because a lot of people would have checked out and miss out on the value that this product and this policy can bring. The question I have for you both is, and I'm curious to see where this might go, is, when we're sitting at the dinner table, whether it's in a mastermind or family, etc., I'm curious as to what you hear, and just as for our listeners, again, facts, not opinion, how this product becomes very beneficial, if at all, or if it's actually, also being impacted when we think about the rise in interest rates, where I think a lot of investors are trying to seek out alternative methods, whether it's creative financing and alternatives to seek for to continue to do what they do best, which is invest. What is that conversation that we would have at the dinner table or mastermind around that? Is it that actually this interest rate thing is impacting all of us, or actually, did you know that you could be actually shielded from this because as these interest rates increase, there's like an inverse correlation, whatever that might be. What information do you have for us who are listening to this Q4 2023 and in this very sensitive time of interest rates?
Where people need to realize with infinite banking, this isn't an either or. We're not saying put your money in life insurance or real estate or the stock market or your business, that this is an and. So those high interest rates are affecting everybody, and that is going to affect the assets. I mean, without a doubt. But in regards to infinite banking, just like Cameron had talked about, this is where we're going to store our capital. Right. So that the high interest rates makes a little impact on it. If anything, higher interest rates are more advantageous for whole life because of the way the insurance companies do their investing. They're not investing in the market. They're investing in a lot of products that are interest rate sensitive. So as interest rates rise, so do profits from mutual insurance companies. And we only work with mutual insurance companies because they will share the profits with us in the form of tax-free dividends. So when interest rates rise, that means we're going to have higher dividends. So oftentimes it's considered, and I actually did a talk at the think tank, which is a annual event for infinite banking practitioners, and we kind of laid out the impact that inflation has on the whole life as a product, and it's going to go up and down with inflation, right? And what we're telling people, let's not focus so much on where we're storing the capital. I mean, it's really, do we store it at a bank or do we store it in a policy? I mean, and be honest, if you really look at the difference between the two, you will come to the realization that there's a lot more advantages of storing it in whole life. But so the interest rate is really affecting everybody. So that really shouldn't impact your decision on whether infinite banking is for you or not.
Ruben, what I'd add to that just briefly is that if you look at, right, we've been in this space for a while, almost 15 years. And if you look over the previous 10 years, we've been in the lowest interest rate environment we'll probably ever be in. And so the message that we're giving a lot of investors at that time was, man, take the cheap money, right? Use the bank's money at that point, take all your profits and dump it into a policy, right? Interest rates are never going to be static. They're always going to go up and they're going to go down, right? So the pendulum is going to swing one way and it's going to swing the other. And so right now, what we've got clients that are in a position is they actually have more options now because they have the policies in place. Is previously, right, we're using the market's cheap money, and now that interest rates have swung the other way, we've got clients that are still accessing capital at 5%, right, when other investors are out there, looking to borrow at 7.5 or more, right? And so because we had some preparation, we've got some education, our clients are in a much better position than most investors out there.
No, this is good to know, because and I thank you for that, Cameron, and I really like what you said, Anthony, around this isn't. Or I think a lot of, sometimes people even look at real estate strategies. Should I do this or that? It's about finding the and that works for you. And I think this is an and that very similar to what you said, that we are all actively doing. You're buying, something in cash. I mean, I don't like cash unless I'm like at the barbershop, right? I'll give cash. But it's and I have a credit card, right? And I have a whole life insurance policy that I can also leverage. I'm more curious to hear, though, right? I've leveraged it in the past, and maybe some of our listeners have as well. But I'd love to hear from you guys. If when is it time? How many of these guys should I get? Should I be having all transactions go through this? What is the pro? What is the con? Of kind of, again, reframing the way we've been taught financially, how to operate. Again, whether it's from the right or wrong person, I think we're trying to hear from you guys. What does it look like for you guys? Is it, I'm doing everything through my policy? Is it big purchases only? What does it look like tactically for a listener out there, so they can start thinking about, oh, okay, this is what this would actually look like, right? I like to give tactical examples to our listeners, because I think it's very helpful to then be practical and for them to know what next steps to take.
Yeah, great question. If somebody's out there and they're doing research on infinite banking, I will say this first and foremost is you're going to hear a lot of guys out there talking about uh, financing depreciating assets. So cars, vehicles, those things. What I would tell your listeners is you can make money doing that, but that is not the most efficient thing that you could be doing with your policies. So I'll take those, set those aside. The other thing that I would tell you is additionally, some of the poor advice that's being given out there is they're telling people to run the entirety of their paycheck or their salary or their income through policies. And I would tell you that, again, that is not a practice that anybody or most people should be doing by any means. When you first start this, number one is you want to start with something that's comfortable and really easy. Um, we've got plenty of time, right? Even if we're a little bit older, we've got time that we can scale up and build more policies. So, what I would tell somebody is the first couple of years, the focus really should be on the education side of it. Make sure you learn and understand this. Watch and monitor your policy and make sure it performs not like the insurance company says and like Anthony and I say, but watch how it performs moving forward. And then as you start to get more comfortable with it and more educated, you can always add additional policies on moving forward. So, what I would tell somebody if they're listening, an easy thing to kind of be a practical example is if you've got cash that's sitting and you don't have a purpose for it in the next 6 months, I would look at opening a policy and trying to get that cash into a policy. The best place that you can keep capital is inside a properly designed policy. So if you've got cash that's sitting, great first step to move over. We usually call that like a kickstart. The second thing that you want to look for is cash flow on a monthly or an annual basis that is going to build up that capital, right? So maybe somebody's saving 1,000 a month or 2,000 a month. I would say consider, a third of that or a half of what you're saving should be directed over towards a policy, and then design it that way. Build up the cash value, and then look at opportunities that you can invest in. Ruben, a practical example is we're not here to tell anybody to do anything. Most of the time when somebody comes to us is we'll show you how to do it. But if somebody's really good, right, in whatever space that they're in, we're going to tell them to stay there. We're going to tell them to invest in what they know best. So if they're great at commercial, stay there. If you're great at medium term rentals, stay there. If you're great at land flipping, stay there, right? But that's the process. If somebody comes to us and we build a policy and they have questions on opportunities that are available to them, here's a shameless plug for our podcast is that half of the episodes are us talking about infinite banking, and then the other half are us interviewing individuals on investment opportunities. So maybe medium term rentals are a great fit for somebody, and we need 50 to 60,000, right, to go buy that property, furnish it, and get it up and going that first year, right? Or maybe we're going to do land flipping. You need just $5,000 in cash value to get started, right? So we have a cash flow matrix that we can walk clients through, and it has maybe 20 to 25 investment opportunities, and it's classified based upon how much capital somebody has to get started, how much time and energy somebody has to get started, kind of expected returns, and then obviously their hold period or when they should be exiting. So that would be practical advice for someone.
Ruben, I'd like to add, we got to start somewhere. We tell people, just like we started small, start small and slow. Get one policy, try this out. And as you feel comfortable, like Cameron and I have been doing this for so long. I mean, now I'm running all my extra cash. I mean, I keep 1 month savings at the bank, and I have some maybe liquid savings in gold and cash at the house. But all my other cash, I got to store that capital somewhere. And Cameron had talked about the many advantages of storing it in a whole life product. So when you get used to this and you get comfortable with it, eventually you will have multiple policies. I have 17, which might sound like a lot, But part of it, you start off small and then you build up and you get comfortable. Or like I have a policy on Cameron. I have a policy up for my kids. I have a policy. We have a key man. I mean, we're just looking for places to store capital. But now this is my rewards credit card for my investing. So I'm throwing money in there. And so now I'm keeping it safe because I think there's going to be some opportunities here in the next year. And I don't know if banks are going to be willing. Banks may tighten up. And to be honest, I hope they do, because that means there'll be less capital chasing the investments that I'm going after. So that people that, just like what happened in 08, when credit tightened, there's a lot of people. I don't know about you, Ruben, but I remember I saw my neighbor's house literally got sold 3 times. And I wanted to buy it each time, but I didn't have the money. I didn't have the capital. And I told myself, this isn't going to happen next time. Next time this happens, I'm going to be in a position of liquidity. So when my neighbor's house goes on sale for 50 cents on the dollar, I'm going to be the one buying it. It's not some other investor who comes in and flips it.
Ooh, first of all, thank you for sharing that, because I think that brings the point home. And then when I hear that 17 policies, also, again, with respect to each his own, we're not saying, hey, the magic number is 17 because Anthony got 17. Everybody's got their own situation. But I love the fact that you're really talking into, you can tap into your 17 different accounts, for lack of better words, right? My question would be, is there a, when you think of the cash value that Cameron was talking about, what is the benefit of having that many, or could those be more or less, consolidated at 5? Like, what is that number 17? Is it because over time, is it because you can't modify an existing policy? Is it because, like, why 17? Why not 34? Why not 5? Why not 3? Like, I think that may be what people are thinking. If I have this model, can I overfund the same one? What, I think you know where I'm going here. So why that number?
Yeah. There's a few reasons. I mean, and one of them being is I wanted to start small. I wanted to test this out, right? And just like you alluded to, Ruben, when we designed the policy, and partly because of the MEC limit, there's going to be some minimums and some limits that we can put in the policy. And we're designing them right up against a MEC line, meaning we can't put any extra dollars in there. Thus, if we want to save more, it's like that first piggy bank is full, right? So if that piggy bank can't hold any more money, the best thing to do is to go get another piggy bank. So part of it is some of the limits of the amount of funding, but also I have family members. So every one of my family members has a policy. I have policies on my wife. This is how we paid for the education for my kids. We didn't do it. We did a 529 plan, but after losing 60% in 08, that's when we had shifted over. And so we use my kids' policy not only to pay for their education, but now my son has flipped a property, and he used some of that cash value to pay for that property. My daughter's looking at buying her first home. Maybe it's a home or a rental property, but now we're teaching these principles to her. So now that she's having some money, she has some more options. And I'm teaching also, I have a policy on my grandson. And when he's got enough money, we're going to buy a rental property with it. And then when he's old enough, I'm going to take him to that rental property. And then when he's old enough, I'm going to show him the numbers. So part of it is more of our legacy planning. We want to make sure the kids know how to handle money. And the best way to do it is for them to handle it with their own funds. And then also our income is our cash, our investments, and our business is growing.
Business is booming, baby. So we got to put the money somewhere. We could put it all in a safe.
Right?
No, yeah.
And then
Yeah.
I got something on Cameron because
Your
he's
business. Yeah.
instrumental in part of this business.
Yep.
Something happens to him. Who am I going to make fun of on the Infinite Wealth podcast? I mean, it'll take some time to find somebody that we can poke fun of. And so, but Ruben, you said it best. You got to find what is best for you in your situation. It doesn't matter what I or Cameron or your buddy's doing. We got to design something that's going to fit specifically
I'm
for
so
you.
glad that this is kind of putting a bow on this. I want to ask one thing, and this is more of a personal question because I'm not there yet, and I'd love to get to this place that you guys are in. So kudos to you both for coming in here and sharing your knowledge. One thing that I think we don't talk about a lot too is just losing loved ones, right? And help me understand in this case, because it's not a matter of if, it's a matter of when, right? That's just the reality of how this game of life goes. And I'm curious to know, and I know that in our culture, that's kind of, you don't talk about that a lot, and maybe some, a lot of homes, people don't want to talk about it. But the reality is, if I understand correctly, the way you've structured, you talk about legacy. I'm curious as to the way you structure your policies, is there crossover in who the beneficiaries are? So if you get a policy on your grandson, does that mean again, we don't even want to talk about these things, but does that mean the entire family benefits? Is it you pick one family member for each policy? Like, how does that work? So we understand kind of nomenclature. Do you tie it back to a trust? Like, that's where I'm not there yet, but I'd love to kind of understand how that works. And I don't have a family of my own yet either. It's just me and my wife for now. But again, when you think about, my parents and, all those, I got 4 siblings, right? Or 3 siblings, excuse me, 4 of us in total. How without, this could be a whole masterclass. Now I understand what I'm saying here, what I'm asking, but at a super high level, is there a crossover with the beneficiaries, and do you structure in a strategic way?
I would say when you're just starting out, most of the time people just have the spouse as the beneficiary, right? But it depends what your long-term plan or vision is. With us, and I guess everybody's different. We have a trust, so all of the beneficiary of these policies, even some of the owners, but that's a little more complex. But sometimes the trust is owning these policies. So the plan is the death benefit comes in.
That's all I needed to know,
entity,
brother. That's
then
awesome.
we can choose what we want to do with it. And I would say at one point the plan was, all right, this kid gets one. The way we had it, we have 2 kids. Each kid got a third. Then the other third, we made the decision to give that third to charity, because we actually have a lot of death benefit, more than my kids need. So, the goal is we want to give our kids enough where they can do anything, but not too much where they can do nothing. Now we're in the transition of changing that. So to be honest, the kids will get a little bit. And then now most of it's going to stay in the trust, because just like you alluded to earlier, what did the Rockefellers do? And on that book, if you look at it, a lot of people had money, and when they dispersed it to all their kids with no accountability, it ended up
100%.
being gone.
Yes.
Like the Vanderbilts are a common example of that, right? But the Rockefellers kept it. And then people had access to it to grow the wealth, but they had to pay it back. So we're transitioning our trust to be more of a long-term wealth builder for the great grandchildren.
Love that. I love that. Hey, Cameron, Anthony was throwing some shots earlier. So while we're here, how many policies you got? Again, guys, we're not making it. We're not making this. It's not about that.
I made sure he had 16.
Yeah.
If he gets one, I make sure I get another one. That's kind of
conversation.
Yeah.
I've got
not a test.
I've got 11 policies, Ruben.
That is incredible, and that's the reason I asked that. I to close this out, I'm a big believer of following those who do not do what I call, I didn't call this, MJ DeMarco called this the paradox of practice, right? It's when you talk about one thing, but you don't actually do it. These 2 fine gentlemen combined, have multiple policies, and they've done this not once, not twice, not. I'm doing the whole LeBron decision thing. Not once, not twice. That's just on a 30 altogether, right? And for two people, so you're not only talking the talk, but you're walking the walk, and I think that's really important. And I want to thank you both for what I always call is you're planting the seed, right? This isn't you just listen to this podcast, and I think you can get a lot of value from it. But if we can plant the seed so that someone can open up that door and go down that education path, gentlemen, I want to give you both an opportunity because you brought so much value to us to give us to give my listeners and those who are watching the opportunity to be able to go more from where it came from, the source. So thank you for planting the seed. But where else can we tap in? I know there's an Infinite Wealth podcast, which if you're watching here, so beautiful logo, beautiful setup you guys got going on here. But what else can you give, and where else can we find out more about what both of you can offer to whoever might be listening and coming across this content?
Yeah, they can, if you guys are interested, you can check us out at infinitewealthconsultants.com. That's our website. You can find all the social media and stuff links there. But additionally, if somebody's listening, and kind of a thank you for them sticking around for this, and also for you, Ruben, is that if they go to infinitewealthconsultants.com/real estate experiment, is that'll take them and it'll provide free access to our online course. So today it was a lot of conceptual stuff, but if they go and they log into that, what they're going to see is a whole bunch of case studies, right? All the facts. We're going to go through in detail examples of borrowing against a policy and why it's better than paying cash. And so, like Anthony mentioned earlier, we're not salesy in any way. We're giving you the good stuff. If you guys go in there, look around and feel like it's a good fit for you, there's a button in there that you can click and it'll take you to our calendar, and then we can talk. So very easy for you guys to go in there, find out, look around, and see if if it's Infinite Banking's something you
Love
guys want
that.
to take
And
a
one
look
more
at.
time, that's infinitewealthconsultants.com/, what was it? Real estate
Real
experiment.
estate experiment.
Appreciate that from both of you guys. And I really appreciate that. You giving that value to our listeners.
Robin, one thing I want to add in there, like you had mentioned earlier, kind of analyzing, like, which is better. We have done that. We've done the math, right? Because what some people are saying, like, they're probably thinking, like, I don't need the death benefit. I hear whole life is terrible. I just wanna invest. Totally get it, right? But we've done the math, and what we've done is we got to store capital somewhere. So as part of this course, we did the math of storing that money in a bank and buying an asset, but then storing those same dollars inside an infinite banking design policy and then buying that exact same asset. So same dollars going in, same going out. And then we look at who has more money at the end of the day, and more importantly, why. So if you're at all open to new ideas, if you're a real estate investor, you really should be doing infinite banking. At the very least, you need to look into it for yourself and say, oh, this is something I should look into further, or this ain't for me. I think that hopefully we provided enough value to at least open your eyes to see if this will work for you. And so you can get on a call with us. Or again, if you're like, hey, I don't want to talk to anybody, I just want to know kind of if this works or not, we got this free offer to get this access to the course. Find out for yourself, and then you can answer that decision. And at least I think you owe it to yourself to at least evaluate whether you should incorporate it.
Absolutely. And Anthony Cameron, rest assured, my goodness, that you guys don't even know. There's a whole process behind getting you guys on here. You're vetted. My goodness. This is what we do. This is not, you guys know that, I only bring practitioners here in the lab with us. So thank you for your time. There's no, you don't need to add any more to what you've already done. I'm a beneficiary of this concept, and I'm so grateful that I can continuously learn a lot of new things constantly. I'm constantly educating myself, and I'll probably go ahead and take the lead on that as well, to continue to refine and most importantly rewire ourselves. Right. The thing that I always say is, it's the opportunity cost of not knowing what you don't know, right? That's real cost, right? Of that the things that you don't know, that are right in front of you. And so, with that said, gentlemen, thank you so much for your time spending time in the lab. Look at these notes, taking notes all over as we're speaking. That's what we do here in the lab.
Nice.
Because it's this information is one thing, but what you do with it is another. So I'm proud of you guys to tap in with Anthony and Cameron. And just like that, we are out. Experiment Nation, podcasting has changed the way we operate as real estate investors ourselves, and it can do the same for you. Podcasting has been the source of the masterclasses that we get thanks to the world-class real estate investors and practitioners and specialists that come into the lab from all realms, from short-term rentals to mid-term rentals to real estate syndications to even software as a service. Owners, founders, entrepreneurs have helped enrich our experiments by giving us the education, helping us build a network, and lastly, and most importantly, a brand association to open up multiple doors for our respective businesses. If you understand the power that podcasting can have and you know that you need one for your brand, please, you can rely on our team. InvestedTalent.com is my team and the team that helps this podcast, the Real Estate Experiment, become the fruition each and every single week to educate my community, build relationships on the air, and continue to build our brand. If you know that you need to do the same for your brand and you haven't pulled the trigger yet, maybe because you don't know how, our company, InvestedTalent.com, does the end-to-end from the time that you record, from the time that it is published, to even repurposing content on multiple social media platforms. That's what my team can do for you. Simply go to InvestedTalent.com and book a discovery call to see how my team can help you launch your podcast.